I found the Capital Economics note, and the title is from Capital Economics is Housing Market Insulated from Banking Crisis. And this note's from March 30th, 2023. They write the latest mortgage market data show the banking crisis has so far had a minimal impact on the housing market. While spreads have increased, the gap between the 10-year and 30-year, overall mortgage rates have dropped and applications for home purchases have increased since SVB collapsed. While it is possible that lenders will already have tightened other lending standards and could do so further in the coming months, we see no need to downgrade our house price or home sales forecast at this time. And I think Capital still 8% peak to trough for price, unless they've come back to 5, which was their initial. And so that's Capital Economics. They're saying essentially, there's not enough there to change any of their forecasts based on it. And so here's the Goldman Sachs one. The note is titled, What to Expect from Tight Bank Lending Standards. And so it goes into it, tight bank lending standards, overall manageable for residential real estate. Investors' focus has shifted away from the risk of a systematic crisis towards the expected aftershock on lending conditions. For residential mortgages, we expect this impact will be muted relative to other forms of lending, such as business loans or commercial mortgages. This view reflects 3 main factors. First, mortgage lending is less sensitive to bank balance sheet pressures to other forms of lending. So they're saying that residential is less impacted by a hit to banks' balance sheets relative to commercial lending and business lending. Only 14% of mortgages sit in whole loan form on balance sheets. Conversely, 68% of mortgages outstanding are effectively stripped of credit risk and securitized into agency MBS. And the second factor pertains to significant sparse activity for mortgage lenders. I don't know if they're trying to say that, it's already taken a hit. So there's not too much more that could take a hit there. That's a little confusing for that second point.
Okay.
And then their third point, lastly, lending standards for residential mortgages had already tightened significantly before recent bank failures, as captured by the Senior Loan Officer Opinion Survey.
Yeah, so so that was Goldman, right? That last one is
and here's just a little more.
Okay.
But to be clear, tighter lending standards will weigh on the residential mortgage sector, but the net impact will likely be more modest than for other segments as small business and commercial real estate loans. So they're saying, relative is what they gave us, relative, and then modest. So we kind of understand where that doesn't tell us a lot that we didn't already probably think.
It's kind of right. At the end of the day, lending is getting tighter is a general statement. Residential will be the least impacted, right? Others will be greatly impacted. I also think they acknowledge that Freddie and Fannie stand ready to buy all of the first-time home buyer home loans that meet their box, right? They're approve eligible, as they call it. And by the way, since that first report was written, rates have come down more. I think you publish nightly the 30-year mortgage, which last I saw was 6.16 or 6.18, down quite significantly. And I don't know if you saw this. I'm sure you have, but the audience hasn't. 1 year ago, rates were 5.04. So it's not like a year ago rates were 3% anymore. We're kind of chewing up the time here.
Yeah.
Rates a year ago were over 5.
The shock effect. The actual shock is when
exactly.
That's right. June is the first time it hit 6 last year. So we're getting close to that. Which should be interesting. It's possible in not too long it could be down year over year, possibly.
Exactly.